All right, big day for us today, Shani. We have another guest episode, and we'll turn the lights down. So we've got mood lighting in here.
It's moody in here.
Yeah, exactly. I was saying that we should have a glass of red wine, but nobody's brought me one yet. So today our guest is Lochlan Holloway, who is our equity market strategist here at Morningstar in Australia. So he sits with our equity research team and he writes Your Money Weekly. So subscribers to Morningstar investors should be familiar with that.
Yeah, so as well as this, he does provide broad stock market analysis using valuations from Morningstar's equity research team. He also contributes to fundamental research on ASX-listed companies in the consumer, industrials, and basic materials sectors.
And before joining Morningstar in 2023, he was an advisor at the Department of the Prime Minister and Cabinet, which is pretty impressive. And he was focusing on fiscal policy there. And he also previously worked as an economist at Westpac.
Very impressive. And I think what we like about Lockie is that he has a really deep interest in economics, and he's able to explain to us about how and why markets behave the way that they do in a way that makes sense. So we want to speak to him about market crashes.
And we haven't had an extended market crash for a very long time. So long, in fact, that many investors who are listening to this podcast wouldn't have experienced one of those drawn out bear market. So we want to start by looking backwards. So we'll look at the pattern of market crashes, and Lockie will offer some lessons on what investors can learn from these patterns, depending upon what happens going forward.
And then we'll look at the present and the future. We'll home in on valuations, how investors should use valuations in decision making, and how it should influence their portfolio and their approach.
Okay, let's get into it. So here's our interview with Lochlan Holloway, the equity market strategist at Morningstar. Well, Lockie, thank you very much for joining us. We start every guest with the same question. You are a market strategist, and I think a lot of listeners hear these titles in the industry and want to know what people do day to day. So what does a market strategist do?
Yeah, sure. So Morningstar Equity Research, we're predominantly a team of fundamental, bottom-up, stock-level analysts. So our analysts each cover 20 or so ASX-listed stocks. My role is to sit above the sort of granular stock-level research and try and draw out the sort of big market-wide insight. So is there a particular pocket of value opening up in this sector of the market, or this sector of the market, or this style or this theme? So it's about finding the larger insights from the bottom-up individual valuation work and then communicating those like we'll do today.
Yeah, so you make a lot of media appearances, none obviously as big as this.
Of course not. This is the big one, Mark.
But yeah, so Lockie has been warming up for years to this moment. But we thought we would talk about market crashes. And the reason we want to talk about that is everywhere you look, there's talk of bubbles. And obviously, I think people are implying that if there's a bubble, there will then be a crash. And it hasn't been a while. So a lot of particularly younger investors haven't really experienced what we would call a crash. So what do you think is important for investors to understand about market crashes so they can prepare if one does occur?
Look, I think the overarching insight, to be perfectly honest with you, is that crashes actually, they always end. I think Morningstar's done a lot of thinking about market crashes, and we have a very long series of US equity data and global financial markets data. I think the core insight is that they end, but also they are certainly a feature and not a bug of risk markets. That is, in my view, the price of admission. If you want equity-like returns, you have to accept equity-like risk. They are going to happen. They happen with a high degree of regularity throughout modern financial market history. They do end, but you have to be ready for them. And I think knowing that from a financial perspective, but also sort of psychologically being conscious of that is important for investors.
Yeah. Now, it probably does not come across to listeners, but we actually prepare for this stuff. And we talked prior to coming on there, and you made a statement. I'm going to quote you to you. You said that no two crashes are the same, but they tend to rhyme. And so what do you mean by that? It's implying there's a pattern. What is that pattern?
I think it draws on work by one of the great thinkers and scholars of financial crises, Charles Kindleberger, who wrote one of the seminal texts on financial market crises and crashes. That was his manias, panics and crashes in 1978. I think the book's in its 8th edition now, showing just how sort of, how relevant the theme is today, as it was back then when in the middle of the Volcker oil shock, big bear market of the 1970s. He proposes in that book a framework, a process for understanding the boom and bust psychological cycle of markets. He draws on work from a contemporary economist, Hyman Minsky. I think the great insight, or one of the great insights about this, is that he doesn't make it dense or mathematically heavy or quantitative like a lot of economics does. He makes it very much a qualitative, psychological look at the cycle of bubbles, which is great. It's easy to remember and easy to understand, and I think that's generally a good thing for economics. The way he characterizes the boom and bust cycle, he outlines a 5-step process. The first step, he calls it displacement. So something new comes along, a new bit of technology, some external macroeconomic change, structural shock that starts off visions of great potential, great promise. He then moves on to the boom stage. That's the next bit where investors really start to pay attention. You start to see optimism building, credit coming into the sector. That sort of creates a bit of a reinforcing cycle. Prices go higher, so you become more confident, so prices go higher, and so on. The third stage is this euphoria or this mania stage where it's just everyone wants in, it's get rich quick, it's keeping up with the Joneses, it is credit and leverage, pumping up prices, speculative finance. That is the real sort of peak bubble part of the cycle. Distress is the fourth of the 5 stages. So in that part we have some cracks starting to emerge, profit taking, maybe a leader stumbles in the theme, maybe a fraud is discovered, and then the final stage, which is revulsion, which is the crash, massive unwinding of leverage, investor pain, creditors don't want to lend, liquidity crunches. Everyone promises this will never happen again, and we recover, and the cycle repeats. So all of that to say that it's primarily a psychological, not a sort of mathematical process. It has happened many, many times throughout financial markets history, and it almost certainly will happen again. The trigger's not always the same, but that general process, that general shape is pretty consistent throughout financial markets history.
Okay, I think the psychological side of it is kind of interesting because obviously, what you're really talking about, these are investor emotions. So how would you suggest somebody prepares, I guess financially as well, but also psychologically, for a crash, which will be inevitable at some point? Not saying necessarily it's happening tomorrow, but at some point in most investors' lifetime, in all investors' lifetime, this does happen. So yeah, how can you prepare?
Look, I think I'll invoke the great quote from Dwight Eisenhower here that, plans are useless, but planning is indispensable, which kind of sounds a bit paradoxical, but basically the idea is that when a crash inevitably happens, whatever grand, finely articulated blueprint you've developed is probably going to be torpedoed because these things come out of unknown places at unknown times and things blow up, and the plan often doesn't play out as you'd expect. But the process of planning and thinking about where's my risk concentrated? If something happens, what am I going to do? Developing a pick list can reveal to you potential frailties in your portfolio or in your broader financial health. They might be useful in the lead up to a crash. There's not necessarily a lot you can do in the moment, but you certainly can control your behavior. Predicting a crash is basically impossible, I would argue, and I wouldn't advocate trying to do it. But thinking about your financial well-being, am I heavily concentrated in one asset or one underlying theme? Am I really reliant on a particular thing going on? If a crash happens, do I have enough liquidity to fund my lifestyle and my other goals? I think that is the more important big picture thing about thinking about crashes.
Okay, now you made the statement that predicting a crash is impossible, but now I'm going to ask you to predict one. So are we in a bubble? There's all this bubble talk. There's talk about AI and tech valuations. What do you think?
Well, lean on the research from our US technology team, because that's where all of this interest is concentrated. The Mag 7 right now, according to our fundamental analysts are pretty close to fairly valued from a bottom-up research perspective. So that would suggest we are not in bubble territory in and of itself. An awful lot of potential reward in AI, but a lot of risk too. So a lot of those stocks that we cover in the Mag 7, they're higher, very high uncertainty rating stocks. But we think the market's broadly got the valuations about right now. They're not screaming as cheap, undervalued buys, but they don't look excessively priced either. Market's got it about right. There's an immense amount of potential in AI. If we look at the Mag 7 as a group, they're trading on an average of about 30 times earnings, excluding Tesla, which is not, I think, crazy for fast-growing, fairly capital light, high margin, cash flow generative established businesses. Commonwealth Bank's on a 30 times earnings multiple. So I don't think that's crazy to pay something like that for a stock like Nvidia. We don't know how it's going to play out, but it doesn't seem .com era concept stock, 100 times, earnings multiples plus. So the short answer is no, I don't think so yet in that particular corner of the market. I'd also point out that the leverage side seems reasonably okay. It's not like these hyperscalers are massively indebted yet. They're funding a lot of the capex out of free cash flow, which is also generally good. So in AI, I would say no, we don't see a bubble, at least not yet.
Yeah, and we'll go back to that in one second, but you did make a statement about uncertainty. So that's a rating that our analysts put out. Could you just briefly explain what that means to listeners? Because I think there's uncertainty about the uncertainty rating.
For sure. So the uncertainty rating is our way of trying to communicate or put a label on how confident we are in the forecasts that underpin our valuation for stocks. So if we think about a very, in theory at least, safe stock like an infrastructure asset, a railroad and a port, you've got pretty good visibility on earnings over a fairly long horizon, especially if they're contracted earnings. So we can be pretty confident in the valuation that we give a stock, like a railroad or a port, is probably pretty close to its intrinsic worth. There's not a lot that we think can go wrong. Always tail events, fine, but we can get a pretty good beat on where that business is heading. Something like AI, coming like Nvidia, which is, we're talking like our industry, which is, sort of 50% year-on-year growth rates. It's very hard to have a great degree of confidence multiple years ahead about where that industry is going to be. We have our base case forecast. We have a point estimate for where the earnings will be. We have to recognize that the band of possibilities is much wider around those sorts of stocks. So when we label a stock like Nvidia with a very high uncertainty rating, what we're saying is that these are our estimates. They are our best endeavor to make a forecast about the earnings for this company, but it could be very different both on the upside and the downside.
Yeah, and I think to add my own 2 cents, I think it's really important for investors to realize that not every company is the same. And so that's why it's important to find things that you're comfortable investing in. And that could be something with this wide range of outcomes or something, as you said, that's very predictable. And yeah, let's get back into sort of AI and .com bubble. And once again, we talked about this a little bit before the pre-interview discussion we had. What are the differences? If we go back and look at that .com bubble, we talked about pets.com, for example. What are the differences? You mentioned some of them, that these companies are obviously established, have a lot of cash. But what other differences do you think between the two?
Look, frankly, I think that's the main one, is the established nature of basically all the Mag 7 being viable, profitable businesses well before this generative AI theme was really a thing. Apple was still a fantastic business well before AI, and it still is, and there is a very rock-solid core business there in the case of most of the Mag 7. That is not the experience for many companies during .com. Like, pets.com's like the archetype example of it had a domain name. And at that time, we thought you had to have a good domain name because, that's how you drive traffic on the net before search engines and so on. So, and it was just crazy valuation for something that was totally unproven and really had nothing there in the end. I would say that the big leaders of US equities today, and this is the view of our analysts, they are genuine businesses. They are funding, as I said, a lot of this expansion through their own free cash flow. They're not relying on IPO financing or debt to do that. That's positive, and I think it puts in a little bit more of a safety buffer there than just pure raw speculation. I'm sure there are pockets of that going on right now today, but for the big stocks, the Mag 7, the hyperscalers, it doesn't seem like it's directly comparable to .com.
Yeah, and those are obviously what will drive the overall market because they make up such a big part of it. So something we talked about was Howard Marks and his view on where things are, and he's using what he calls the InvestCon scale. So maybe talk a little bit about that because I think it kind of reinforces what you've been saying as well.
Yeah, so I think the way that Marks, he used InvestCon as he drew the parallel with the DEFCON scale, the Defense Readiness Condition, which Hollywood kind of popularizes as the nuclear threat level. I think DEFCON 5 is like low threat, everything's kind of easy breezy, and DEFCON 1 is like nuclear Armageddon is on the brink. He mapped that across to the investing landscape. He used a 6-notch scale where InvestCon 6 was okay. Maybe you stop putting new money into risk assets. You go up to the next notch. Maybe you're tilting a little bit defensive. All the way up to, you're either stuffing cash under the pillow or you're going short in the market, kind of up at the 1 DEFCON or InvestCon 1. He describes today's market as about InvestCon 5, so 1 notch above the lowest threat level. I think that's probably reasonably similar to the way we see things today. That, they're a little bit expensive, but this doesn't look totally crazy to us, and we would also, I would temper that, or I would add the caveat that in the short term at least, valuations are not a great predictor of equity market returns, and just because the Cape-Shiller price-earnings multiple is very high does not mean that a crash is imminent. This may well go on for quite a long time, and to sit that out is potentially a big error of omission, opportunity cost, as opposed to staying in and riding through a potential correction should one come. So he puts it something like, valuations are a bit stretched but not nutty. I think we're probably in a similar boat if I look across our coverage.
Yeah. How much do you think, obviously, your team, very focused on valuations, how should investors think about that as, things kind of bounce around between, and you said things are not too nutty, but, get a little fairly valued, overvalued versus when things are cheap? How should people think about that?
Yeah, so I think it's a long-term compass, valuations. Over 10-year period, they are a strong determinant of future returns. Over a short time horizon, a quarter, 6 months, a year, even a couple of years, it really doesn't have a great statistical or historical correlation. So they're not, or I would argue they're not a timing tool. They may be a long-term sort of strategic asset allocation thing. Maybe you tilt a little more this way or that way, but they're not for timing the market or predicting a crash. I mean, the great example, and I'll attribute this to Ashwath Damodaran, and another thinker about corporate finance. He had a look, and when Greenspan was warning about irrational exuberance in 1996, if you pulled your money out of equities and put it into cash, you would have underperformed an investor who'd have stayed invested the whole time, rode the bubble for the next 5 years, crashed, and then started rebuilding from there. So the smartest people in the room can still say that, equity markets are expensive and overpriced. You may very well be better off just sitting in there and riding it out. So I think, to the original point, it's a long-term compass. It's a tool to make you a bit more aware of concentration and being a bit more selective, but it's not a timing tool.
Yeah, and I think related to that, it's November 6th. We're recording this on November 6th. Now, markets went down for like 3 days at the beginning of this week. And predictably, I follow all of these different investing Facebook groups, and it's buy the dip, buy the dip, buy the dip. And markets have not gone down a lot. Very minor moves, but down. And we're getting all this behavior. And I think that we've seen this a lot. And I think people are conditioned, back what we were talking about before, that there hasn't been a big crash in a while. So people are conditioned every time the market pulls back a little bit to quote unquote buy the dip. What do you think about this? What are the potential issues with that type of behavior?
Yeah. So in the very long run, history would suggest that buying the dip is going to work. As I said right from the top of the program, history shows that every crash has ended and equities eventually continued to march upward and to the right. In the short term, though, it can be very painful financially and psychologically through some of the most severe crashes of financial market history. Like, if we look at Liberation Day or DeepSeek or even COVID, you got to pay back very quickly if you bought the dip, and credit to you for doing that. But every now and again, you get a complete mother of a crash, and it is, the drawdown is brutal and the time to recovery is long. If you bought in the GFC, US equities, this is specifically, if you bought in the GFC, after equities had corrected 20%, right, we entered bear market territory, all equities took a year and a half and they fell 50%. So you would have had to stomach another 30% from peak before it even bottomed, and then took years to recover. And if you held on the whole time, you would have done all right in the end. But a lot of investors, I imagine, probably don't have the conviction or the stomach, understandably, to do that. And we think about, the great crash of 29, the biggest crash, that was, 80% peak to trough. So you buy after we're in bear market territory, you've got a long time to fall when you're in the red and a long time before it recovers. I think the great example to try and understand, because I, of course, didn't live through the Great Crash. I was alive during the GFC, but I was investing through it, so it's hard for me to sort of imagine how hard it is. But Paul Kaplan, who used to be director of research here and has done a lot of writing on bubbles, he developed this thing called the pain index, which is a way to sort of quantitatively measure how painful a bubble is or a crash is, both in terms of the drawdown but then the time to recovery. Very simply, what he did was he said, all right, if you can picture a stock market chart, it sort of gradually ticks up and every now and again you have a correction where it jolts down and comes back up again. If you filled in the little divot left by that dip, and then you benchmarked it against the size of the divot left by the Great Depression as a percentage, that sort of is a rough way of benchmarking how painful a correction was, looking at the relative size of the huge hole left in markets versus the crash of 29. COVID was a pain index of 2%. 2% as painful as the Great Depression. And I remember COVID, and it felt very painful and very financially distressing and sort of existential. Imagine something 50 times worse and trying to ride that. That is buying the dip, long run it works, but I think it can be very painful in the short term, and you've got to have a stomach to do it. It's paid off recently, but it can be long and it can be painful, history would suggest.
Yeah, and I'm pretty old, but I also missed that 29 crash. But I do remember the GFC. I was working and investing, and I think people that have not experienced stuff like that don't really understand like how that breaks your will when it's like years of it. And also I think, COVID's a little bit of an example because there was other stuff that was stressing us out, certainly health outcomes and everything else. But also, I remember I was very worried about losing my job. So you have that on top of everything. So it's like another reason being like, oh, I should go to cash. I might lose my job. So there's a lot of external pressures as well.
Absolutely. And to that point about preparing, it's like, well, you can't foresee a COVID event. It's totally like, tail risk, black swan thing that comes out of nowhere. But being aware, if my dividend income is cut by 20% or my portfolio falls by 30, 40%, can I stomach that? And is that going to push me to negative equity or margin calls, or I'm going to have to really cut spending or move out of my house or something like that? That's that kind of stress testing of your own portfolio is, I think, probably the greatest thing we can take out of the preparation phase and understanding crises, that we should be thinking about that well ahead of a correction.
Okay, great. I think we'll leave it here. I thought it was a great conversation. We learned about InvestCon. But thank you very much for joining. Really appreciate it.
Thanks for having me.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and/or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.